The biggest issue is that there's more spending than we have income. And that's a problem. The question is, where are you going to get the money from? In the 12th and a half cycle, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, new monetary system. And you know what happens. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And of course, that put a lot of money in the system. You've got the demand, you've got the cycle, classic cycle, right? Stimulation, credit becomes debt, then you have inflation, then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trash. Now cash is relatively attractive. Classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right? So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down. What we have here is that there was quite a lot of bubbles in this. So you could see which sectors are going down. You could see which stocks are going down, right? You see the tech stocks, you see real estate going down. Residential real estate goes down, but doesn't mean that their families are hurt because the household sector is in a better financial position than it ever was. So you're seeing this type of contraction. So it's going down and we're having something close to a let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate.
Right.
What's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very, very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money. This type of recession is not a bad recession. It's a lot less bad than I thought it would be because of the fact of how it's distributing and shrinking that credit. At the same time, though, we have a real issue for the United States debt in the world because we're selling all this debt. If you look at wealth instead of GDP, wealth is a much better indicator of things. GDP is like looking at revenue. How much did you sell? We have borrowed a lot of money, okay? And now we're having a problem selling that money around the world.
Right.
And it's also happening that this political situation, geopolitical situation, is weakening the demand for U.S. bonds. The biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income. And that's a problem. Governments run the same as your household or a business in that, with two exceptions. They can print money and they can tax, right? So then when you spend more than you earn, the question is, and they're going to spend more than they're going to earn, where are you going to get the money from? Are you going to get it from taxes? And if you get it from taxes, people fight because they don't want to give up their money. Or are you going to get it from printing the money? And so how do you achieve that balance? Because do you spend less?
Right.
Well, it's a tough environment to spend less. You have to spend more on defense. You have to spend more on rebuilding. The Green Initiative is expensive. I mean, education is expensive and so on. So there's a dilemma that she is sitting in, that we as a country are sitting in. So how do you solve that problem? There's a lot of things that you can invest in that will produce returns. For example, I don't think we invest nearly as much in the basic things like great education. Invest in those things that are going to produce productivity. Education's a good thing. Infrastructure's a good thing. Other things. But this is part of a cycle, a big cycle that has happened over and over and over again. You have something, substandard growth. Right, you have that, when we call it a recession, I can't tell you, is it 1% growth or something like that, but it's a fairly stagnant growth that is not hurting the household sector as much as you would think in terms of that. So that becomes tolerable for longer. So then you look at the markets as a whole. So now you're going to have probably a tightening or a tighter monetary policy than existed